Welcome back to Good Returns. I'm Matt here with Garrett, and today we're doing our Q2 quarterly review. Same format as we did after Q1. We step back from the week to week and ask the bigger questions. What actually happened this quarter? What drove it? What does it mean? And what are we watching heading into Q3?
Yeah, we actually had a pretty interesting story for the second quarter. Q1 was definitely, I think we called it a quarter to remember at the time. So this one has more of a narrative arc. We started kind of in chaos and ended near all-time highs. So we'll get into that and kind of see if we can give some context to it.
Yeah, we've spent the last 4 months covering the story week by week. Today we will get to connect the dots and give us a quick little disclaimer.
Yeah, well, I'm getting tangled up here. Quick note before we do get started. Everything on Good Returns is for educational purposes only. Nothing we say is personalized financial advice for your situation. We may or may not be your financial advisors. We're going to give you context and that kind of help you think more clearly and feel more grounded when, if you decide ultimately to sit down with a professional, you at least know some questions and some starting references. So.
All right, Q2 2026. Let's start with the headline. The S&P for the quarter gained 15.2. Now, that is the strongest single quarter since Q2 of 2020, the early stages of the pandemic recovery. The NASDAQ gained 27.7, the Dow rose 13.4, the Russell 2000 21.5. They all look large, but let's dig in a little deeper.
I mean, they are large in isolation. It's genuinely strong. It deserves a full context, though, because that's not, if you look at the year-to-date returns, they're not up that much. I think the S&P is up about 10% year-to-date. It's a solid return. It's not, spectacular, but the gains that we saw in the second quarter were largely due to the losses that we experienced in the first quarter. So they had some ground to make up. And so that is a strong recovery. We would look at that as a strong recovery. It's, it does deserve to be put in context, though, with what happened in the first quarter. But it doesn't diminish the strength of it any. I mean, we saw a lot of good things from it. We'll talk about breadth and things like that in a little bit later, but it's a strong quarter.
Yeah, it is. And that's the way to look at it. Q1 ended, of course, with the S&P down over 4%. Strait of Hormuz closed, oil above 100, CPI prints on the upswing, and then the market pricing in the possibility of rate hikes. So when you look at, your quarter, the quarter began at the very low. So to get back to where you were is going to show some pretty good returns. So that's
why the comparison to pandemic is there.
Yeah, exactly.
Had much the same thing. You had a big pullback, and then you had to have stellar gains because you're just getting back to where you started.
To where it was.
A lot of people don't understand that. That's kind of an important thing to look at too, is when you have a pullback of, let's say, 10% in the market, you can't just have a 10% gain and get back to where you were. The math doesn't work that way. You have to have more of a gain. So you have more legwork to do on the upside than you do on the downside to recover from something like that.
Yeah. The quarter opened, of course, with the markets digesting that oil shock, right? Because oil was, I think it definitely peaked.
Mm-hmm.
Yeah.
Yeah. I mean, we've talked about oil. Again, I don't want to beat a dead horse here. We had the ceasefire framework announced, oil starts falling. There's a little bit of time there, I think last week's episode or the week before that, where they had made a deal and then the deal was off or something like that. And we were saying that the market was closed, but we can figure out what was going to happen by Monday. And of course, by Monday, we had both sides coming to the table again, and the market largely ignored it. I think, what is oil in the 60s at this point now?
I think the high 60s. Yeah, definitely the high 60s. But we did see recovery. We saw the S&P, of course, have a nice winning streak, set some new all-time highs. The recovery was real. Fundamentals behind it were real. But we want to make sure we read the scoreboard accurately. Year-to-date really paints a better picture than just the quarter. And especially when you're planning and thinking about long-term risk-adjusted returns, you want to do that because it helps put things into perspective. Because you're, as an investor, you're in the game for 20, 30, 40 years, not for a quarter or for 6 months. You're in it for the long run of how do you, in a risk-adjusted way, grab these returns that you need, look for areas where you can exceed those needs and those expectations, and do so in a manner that mathematically gives you the best odds of compounding your wealth over time, whether it be 10 years or 20 years. That's the way you have to look at it. So, there were some things that didn't participate in the rally, kind of took it on the chin, gold and Bitcoin. We'll talk a little bit about both of those assets and what we're seeing in those assets and how we're thinking about them going into the second half of the year.
Yeah, we had a really meaningful pullback in gold in the second quarter, which is, even more significant if you look at what gold is traditionally supposed to do. Gold is talked about religiously as a classic inflation hedge. When inflation runs hot, you're supposed to see gold and other commodities either hold their value or rise. And we didn't see that. During a quarter where we had headline inflation hit 3-year highs, gold sold off. So
and our
what does
data
that tell us if we look at it?
Well, our data to go into gold started in 2023, well over 100%, 120%, and rebalancing and profiting, selling those profits all along the way, provided a great diversified excess return generator to where you don't have to have all your eggs in one basket, call it the whatever equity ETF you may be in. And so gold generated some meaningful returns for us, but we did get a sell signal based on our data and executed that accordingly. And we saw that as we were glad it generated the profits that it did, but we saw that really as a very positive sign, because it's telling you the market does not believe that inflation is structural. When you have gold selling off with a high CPI print, the market is saying, we're looking past this. This is not the trend. Now that really gels with both of our theses and my very strong conviction that the trajectory of rates is to the downside for several reasons. And now you're having gold tell you that. Now, it doesn't mean that gold may or may not appreciate. If somebody that's listening to this and you've bought gold, depending on what price you bought it at, you may very well still want to hold it. But it's telling you, the market is telling you there's going to be better returns elsewhere, in part driven by the fact that rate hikes are not in the near future, right? I mean, at some point in time, 10 years from now, the rates will go up again. But in this market cycle, that gold sell signal is telling you that while the energy shock was in fact real, and the CPI print does represent the reality of the situation on the ground, the long-term inflation picture hasn't changed, and one could argue that it's actually gotten much more, inflation may be much lower in the future than people realize. Now, that's consistent with the bond market signals that we're seeing. There's some, we're not really quite to the point where I'm willing to make a really high conviction statement on the bond market, but I will tell you that all things, the pendulum swings always, and bonds have gotten beaten to a pulp. And I do think that we may be approaching a point in time where that changes. And that means rates go lower, bonds go up. So we're seeing that. Again, our internal sell signal, that was the first time since 2023 that our sell signal did flash on gold, and we welcomed it.
Yeah, and it's specific to what we use internally. Other people may have different things. There also may be there may be something true to the fact that, yesterday was a really good day for gold and gold miners, for that matter. So, have we found sort of a bottom in this year-to-date pullback that we've had in gold? I mean, that is very possible. It's possible,
but I think the signal is really underscoring that there are better returns to be had elsewhere.
Right, of course.
And then when you look at risk assets, and let's bring Bitcoin into the equation.
Yeah, Bitcoin had a difficult quarter.
Bitcoin did have a difficult quarter. Now we had a few periods within the quarter that just a simple, maybe say 5 or 10% allocation to Bitcoin actually produced that bounce over 80 grand, produced such significant outsized returns that it really helps reward those patient investors that are allocated to blockchain assets as a portion of their portfolio. Really gave them a nice bump of saying, hey, we remember what it was like to go from 30 to 120. And so now we're getting a feel for what it's going to be like to go from, 60 potentially to 250, which going back 2 years ago, that's always been my price target to look at for several reasons, is around 250,000 Bitcoin. We can get into that, I'm sure, at a later point in the year if the data and the charting is to lead one into an area of price predictions, then things will probably begin to get very interesting here as we get to the second half of the year. But when you look at the sell gold signal and you look at what's happened with small cap, and then you look historically at year-to-date performance of the S&P, it's telling you that the latter half of this year has the potential to be very rewarding for diversified portfolios and risk assets. And that includes your blockchain technologies such as Bitcoin and Ethereum. So
that's kind of the theme through at least Trump's, the years that Trump has been president, even go back to his first term. You have these sort of years that rhyme with each other, where you have a kind of a good start to the year, and then middle part of the year, second quarter, you get some murkiness, and then you end the year strong. And that tends to be what we've seen in the last
you can track
few
this
years
too historically, which we haven't talked much about here recently. But there's always very interesting to look at. The correlation is not strong enough to make trading or allocation decisions on in and of itself. But when you look at election cycles and you look at midterms and you look at 4-year presidential cycles, agnostic of outcomes, there's enough noise there that you can kind of see patterns. It's not enough to make allocation decisions on, but I would agree with you that at least in the recency bias would definitely agree with that you can kind of see a little bit of a rhyme.
I'm not at all suggesting you use that as a trading strategy. I'm just saying it's an interesting, at least anecdotally, when you look back, that you kind of see patterns there.
Yeah, but definitely with oil peaking at 115 and then coming all the way down into the high 60s, every dollar of that war premium is just gone. It's just absolutely gone. And all of these things, again, line up. You have to wait and you have to see, because the number one thing is to have a long-term plan, and you want to be allocated to risk assets. You want to be allocated to the equities. You want to have a little bit of piece of the pie of the future, as we call it, with blockchain technologies, because the annualized compounded rate of returns of those are so significant that it's okay to have the volatility. It's okay to because that's really the price you pay for the returns, and it's okay to let it work out its course and then take those profits and continue to invest in every other aspect of your portfolio. And sometimes that may be bonds, So it's, I'm kind of going down a, rabbit trail here, but the underlying trend that we're seeing is extremely strong. And while you have certain areas of the market, such as AI and such as, a lot of these kind of things that have really ran up really quick, and then like yesterday, we saw some of them come down really quick. Mm-hmm. The most important thing in your long-term portfolio, in your retirement portfolios, in your 401k, is to have a really good high level of confidence that the plan is working and risk assets are where you want to be. And this year is nothing but reinforcing that when everything was thrown at this market, but the kitchen sink, and I guess maybe you could argue the kitchen sink was thrown at the market in March or April. And the rotations that we're seeing, the responses to liquidity signals that we're seeing are all very strong. And the oil chapter is closed. I would absolutely think that we don't have to talk about oil again.
Let's hope not.
For quite some time.
Let's move forward though and bring in that AI conversation, because that was a dominant story of the second quarter. AI and specifically semiconductors. We had that stock, the semiconductor stock sector, had its strongest quarter in like 30 years. I mean, the group before the pullbacks that happened in the last few days, that was up like 100% in the second quarter. It was just unreal, unbelievable. Again, largely because you had a pullback before that, But to find a comparable period to that, at the risk of going off on another tangent, you got to go back to the 1990s, and everybody's comparing it to the 1990s for various reasons. There are maybe some reasons why it's similar. There are more reasons why it's not similar. All the kind of things line up, but it is very. That's a big move. I don't know how else to say it. That's a big move.
It is a big move. It's a big move, but depending on if you did allocate to semiconductors, you had 30 or 40% losses from the top to what happened, by the time yesterday closed.
Right.
So it's definitely a wild thing to see. The spending on this infrastructure is real, and we've talked about it. But some of the price actions that you're seeing in some of these names is perplexing. But if it's a position that somebody's held for a while, that's great. But this is why you got to pay very close attention and be careful about the FOMO, the fear of missing out. Because if something runs real quick and then you see it, and then you hop into it and you take a 40% hit in 72 hours or whatever it may be, depending on the name, that can be a gut punch. So you got to take everything with a grain of salt, and again, build a long-term structural plan, because you think about the 90s and you think about some of those names that ran up. Now, the difference here would be is these companies are actually doing something, actually making real money. In the 90s, the problem was, pets.com and these names were all running up and nobody was making any money. So you have these companies that actually are making a lot of money. The question is, will they continue to make that much money, or will they, have competition that comes in? And then we all know that anytime you have an enormous amount of money flowing into tech, tech is notorious for reducing the cost of what it is they both need and what it is they produce. So whatever side of the supply chain you're on, if you're producing memory, if you're using memory, if you're producing GPUs, if you're using GPUs, you're going to find a way, because technology always does that, to reduce cost. And we may very well be close to entering a period of time where some of these names are going to pull back, and it's going to be because of the lower cost of this technology making its way to the consumer, whether it be through competition in memory, whether it be through innovation, the ability to use LLMs without using as much memory, and whether or not the robotics revolution that's occurring will in fact use as much memory as people say. So you could end up in a situation where you have productivity gains and growth, even with these semiconductors or names like them coming down. That would be a structurally good thing for the overall market, because you're cutting out the froth. And
I would imagine that that's like in the future, if to see that, because you look at, Apple famously just raised prices across the board on all of their products because of chip costs and semiconductor costs and things like that. And so you have different sectors. You have, their Apple TV product, for example, went up, like 70%, almost 70%. They raised the price of it. And so maybe that happens. I think the more interesting thing to watch, and this is something we'll be watching for in the third quarter, but even beyond that too, is, they have to be able to keep up with the spending, and they have to be able to keep up with the revenue, because they're already at such high valuations for, what that looks like based on a historical precedent. So if they keep earning, and if they keep making these record profits, it keeps moving along. My question is, what happens when the first quarter comes around, that maybe they meet what they did last quarter, or maybe it's like slightly under, and they're not, exploding revenues every single quarter after quarter.
Yeah. And that's not to say, again, everything has to be taken in consultation really with your financial advisor. If you don't have one, go to momentumwealth.us and we'll be more than happy to talk to you. But it reminds me a lot of Moderna. We spoke about this before the show. It does remind me a lot of what happened during COVID with Moderna. Moderna, for those that may not be aware, was the first ones really working on RNA-style vaccines, mRNA, messenger RNA vaccines. And so they were like, just happened to be working on this stuff when, something came about that the only way to vaccinate against it was using mRNA or one of the most effective, I guess, ways of doing it would be mRNA, from my limited knowledge on the topic. And they made an enormous amount of cash. Now, they did have some competition that came along. And, of course, viruses mutate, people get immunity or what have you. The need for the vaccine wanes. What happens to the stock? They made real money during that period of time. Now, obviously, the same thing can't happen here when we're talking about memory or we're talking about semis. But when you have that much money, you're going to have competing forces trying to get a little bit of it, and they're going to do so at a lower cost. And so you run the risk, like you're saying, of, well, let's say one of these companies is, say Micron or whatever, is looking for 100 billion this quarter or something like that. I mean, they're making, it's just like a money printer over there. So say it's 100 billion and next quarter they make 99 billion.
Yeah.
It's gonna drop like a rock.
Yeah.
So it's gonna be very interesting to see. But the spending is real, and it will drive long-term productivity gains. And you look, we'll talk about a little bit here, just to deviate a little bit, because this is something I haven't seen most people talk about. So Elon Musk had spoken earlier this year, or announced the chip fab they want to make. I think the largest factory on earth is the Tesla factory in Shanghai, and the chip factory they're going to build here is now going to be the largest factory on earth, bigger than the Tesla factory in Shanghai. And what people aren't really talking about is what happens when, whether it be him, which he's got the resources now after this SpaceX IPO, or anyone else actually starts fabbing their own chips. It's going to put downward pressure on not only NVIDIA's margin, AMD, and anybody else that's making chips. And you're going to see these things become more commoditized and less specialized the more money that gets poured into it. That's really what we're looking at here. When I'm thinking about the next 20 years, I'm thinking about there are a few ways we get to those annualized compounding returns that we all need to grow our wealth, give ourselves pay raises in retirement, and have a good diversified portfolio to where, yes, you're going to have some positions that are going to be down and some positions are going to be up. And then next year, the ones that were down are going to be up and the ones that were up are going to be down. Yes, if you can have every position up every year, that's great. That's wonderful. But the reality is you're going to have pieces of your portfolio. And that's really with anything. If you had a rental portfolio, you're going to have that. Some houses are going to do great. Some are not, if you're Airbnb or whatever. So you're going to have this tension within the portfolio, but that structurally brings less risk and more return over time is the idea. But ultimately, when I look out over this 20-year period, we want to see the productivity gains actually happen. And the only way that happens is price compression of everything within the supply chain, which naturally means some of these companies that have a monopoly on a lot of the supply chain of AI, or even if they're the main dominant factor in it still 10 or 20 years from now, their prices are going to have to go down. And I mean nominally go down, not inflation adjusted, but actual in nominal dollar terms, the prices will have to come down to have the productivity gains.
Yeah.
What were we talking about?
Well, we were talking about AI spending and revenues and things like that. I mean, that is the thing to watch. We can, we talk about it quite often, and I'm sure we'll continue to talk about it. But that is the thing to watch as far as profits and earnings and keeping pace with existing sort of status quo. And we may find ourselves in the place where even just staying at the status quo with earnings and revenue is not good enough.
Yeah, and the technology can be right, but the price of those stocks can be wrong. They're not, it's not necessarily, one versus the other.
Right. Well, that's in the context too of the long-term type investor.
Yeah.
And that, it's much harder to be sort of a day trader or somebody that's moving in and out of something. It's you want to find companies that provide value to you and really hold on to those companies. And that's where, index funds and things like that come into play, and they're a good representation of these companies. And historically they have been a good way to do that. Now, we are getting into sort of a questionable period of time here where they are starting to be overly concentrated in these sectors that we're talking about.
Yeah.
And when the time comes when we're not having the record earnings blowouts and all that kind of stuff, what effect does that have? We kind of saw that.
And record could be the dollar amount these companies are making can still go up, but if the percentage change is decelerating, they're going to get hit. The algorithms are going to go in there and they're going to whoop them.
Or if there's some geopolitical event that happens and it affects some area of the world where, supply chains there's a lot of things that could happen. We're not here to give our armchair theory about what's going to happen, but there are things that could happen. It's going to be a narrative that we're going to continue to watch.
Which we didn't really speak about this particular point of view or opinion before the show started, but it seems that we agree. So how can we hold the view that the second half of the year is probably going to be pretty darn strong, and it's probably going to be a broadened rally, and it's probably going to reward other risk assets that have kind of either taken it on the nose or been asleep? We mentioned Bitcoin, we mentioned Ethereum.
Gold, potentially.
We mentioned gold as well. So how can we hold that view, but also say there could be a cautionary tale with what has been driving the market year to date? And I think that's the story that's kind of underneath all of this, is the broadening that we're seeing.
Yeah, we're already seeing that happen. It was clear yesterday, actually, was a perfect example of it, where we had semiconductors just absolutely get destroyed. But in the light of, almost 100% return in the past 90 days. So some of these stocks being down 10 and 15% is a big swing, but not in the context of where it came from in the last 90 days. So this is the idea that you have to be okay with. If you're going to be somebody that's investing in this type of sector in large portions of your portfolio, maybe if you just went in whole hog on the semiconductor sector and you made a really good amount of money over the last 90 days, but yesterday you looked at your portfolio value, maybe you were down 15% or 16%. That's completely normal. We've talked about it before. The market giveth and the market taketh away. And in the context of that, it may be something that leaves you scratching your head, but that is sort of the way, that's the nature of it. And so what happened yesterday was sort of a broadening in that we kind of rotated. And this is, again, one point in time. This is something that we're seeing early signs of, where you're rotating from one sector into other sectors, such as you mentioned at the beginning of the show, small caps. Mid caps is another sector that is taking advantage of that. And so Russell 2000, you've got up 21.5%. Like we said, mid cap stocks gained similarly. International stocks with emerging markets, specifically developed international, has kind of taken a backseat to the performance of emerging, but they were up 24%. So, I mean, it's interesting to see it play out real time.
From the low.
Yeah.
From the low. Strip out tech, S&P's cut in half. Mid cap's doing well, small caps are doing well. Remarkable numbers. Again, Q2 started at the market low, the local market low. But still, we got good recovery, and what we are seeing again is painting a very strong picture, wind to the back of the second half of the year. That in January, before all the stuff started, we were seeing a very strong structural rotation that we expected, and as we've gone through this drawdown and now this recovery, we're starting to see it kind of meaningfully pick its head back up. And again, that's what we want to see, because it means the rally is going to continue. It means it's going to broaden, and it means that, again, for those that are diversified, you end up with a better risk reward metric. And if you are concentrated, 100% concentrated in some of these things, now may be the time to reach out and speak to an advisor if you haven't, and think about rebalancing. Think about what it means to have different portions of your portfolio doing different things, right? Just because it's one account number or one 401k, you can still diversify within it. So if you're at 400,000, think about what would it mean if you had 4 different accounts at 100,000, each with a little bit different of an approach. You can take that. You obviously don't have to split it into 4 accounts, because you can do that within your 401k. with the proper advice and consultation, you can diversify and not give up returns, but have a better risk reward metric that gives you the confidence to continue with skin in the game and not have to emotionally deal with what it's like to go through a bear market in just one sector, right?
Yeah, 401k is actually a really good example for that because of the fact that most people are putting in their 401k at least on a biweekly basis. And so when you buy in, obviously we talk about it a lot on here, dollar cost averaging is in your favor. And so you're buying in at all these price points. So when you have the market down 10% in any given period of time, and you've consistently bought into that over time, your upside is exponential on the other side of that when assets start to recover. So if you are in a 401k environment, specifically if you are being more active in that 401k environment and you're not just allocating to, your 2055 target date fund or whatever you're currently in, if you are being more active about, do I need some small cap exposure this quarter? Do I need some emerging markets exposure? Should I pull back on my developed international exposure? And, all these kind of conversations that are happening, if you look at that, at least on a quarterly basis, the research shows that you're better off doing it that way.
Yeah. Long term.
Right.
You're going to have periods of time where you could always look back and say, I would have been better off if I didn't. But when you stretch out, you zoom out over 15, 20-year period of time, the research shows it and you can't argue with it. You absolutely can't. And we're looking at, a situation where as we start Q3, we've had small cap, we've had international outperforming. What are the reasons that we're finally seeing these other parts of the market that have been ignored starting to punch above their weight class, for the first time in quite a while?
So there's probably, when you look at it, there's three reasons that the rest of the market has to catch up to the S&P 500, which we talked about yanking out technology, which is essentially just the tech sector. I mean, it's starting to expand now, which we're talking about, but
even within the tech sector, once you strip out those top
sector
eight,
within the sector,
once you strip that out, the lower 2/3 of that tech sector are actually showing some pretty significant strength,
right,
as well. So that's something that we have to, comment on.
So if we look at it, there's three reasons. We have to look at profitability too. You have smaller companies that saw the margins compress a little bit in 2022 and 2023 when inflation spiked. And as the Fed cut rates during those years, the interest savings that flowed directly to those smaller companies' bottom lines, they tended to help them because of their debt situation. They carry more floating rate debt, so those rate cuts help them disproportionately. The second is the economy. Those smaller companies are more sensitive to the domestic economic conditions. And so the resilience that we've seen in the economy, despite the oil shock and really in the face of it, has been a direct tailwind for those parts of the markets. And then the third is valuation. So you've had years of mega cap technology leading the market, and smaller companies have generally become cheaper. And so it's a more attractive position. As their earnings improve, that is a discount that's hard to ignore for your investor that wants to seek out growth potential.
Yeah, and what it means practically, and we've said this different ways throughout this year, is that the diversified investor at periods of time are going to have a different, whether it's a quarter or whether it's the last 5 months. This has been a time period where you're going to have a different experience than the S&P headlines suggest, but a portfolio that is across company sizes and sectors and geographies can both capture these AI-driven gains, but the broad implications of those productivity gains across the rest of the market, while also still giving you exposure to alternative asset classes that you want to look for to come in and start punching above their weight class when everything else starts trading sideways potentially. So we're really seeing that play out, and it's been very rewarding and positive to watch that. Because ultimately at the end of the day, again, and I'm just beating a dead horse, but it's true. When you're a long-term investor, you have to keep a long-term perspective, and you want to see a framework in the near term being laid that gives you a higher degree of confidence going forward. And we are seeing that both in the economy, both in the bottom line of companies that provide real services that's not just trading on hype, and both in the advancements of, we spoke about AI, everybody knows about that now. We have space travel, which is now just barely scratching the surface of potentially what type of growth that could bring to the economy. We have robotics that, again, is really, in my opinion, people have absolutely ignored robotics over this narrative over the last year and a half, 2 years of AI, when, the manifestation of artificial intelligence or artificial general intelligence is in fact going to be robotics to interface with our day-to-day life.
I don't think it's been ignored. There's smaller companies that are coming out. There was a company this week that announced a robot that you can buy that's on wheels or something that can like monitor your house or something. But it's wrapped in with the larger picture because most of the robotics companies are already taking part in the AI.
Yeah,
play.
that's true.
So you've got Tesla, you've got Amazon, you've got all these companies that are real big technology companies that are building these robots, and just they are a part of what they're doing. And so you look at valuations for a company like Tesla, where a lot of people are saying that the robotics are being played into the valuations. And
that's true. That's fair.
There's, I think it's, obviously it's a new field. And so you can have these kind of showings of this technology, but at the end of the day, it's still sort of a new technology. I mean, you've had the Boston Dynamics robots that have been, they've been putting videos out for years of the dogs, and then the ones on two legs that walk around and do flips and stuff like that. So it is slowly getting more, into the ether, I guess, but it's just because the larger companies, that's what my argument would be. The larger companies are already there. They're already taking part in the run up. And so I don't know that it's necessarily being ignored. It is going to be interesting though, what utilization they have and where it, what sectors it affects the most. And really hospitality is the one that I would say to look at.
It's very interesting because, I've experimented with the robot mower.
Yeah. Well, I have a robot vacuum that cleans my house every night.
Mixed success. Well, I've gone through 2 robot vacuums. Both have broken. The robot mower broke too. But
you're just really hard on robots.
I did the thing, and I saw different, like there'll be a robot changing the dishes or whatever. And then I was listening to some of these tech guys. This is probably like 2 or 3 years ago, and they were talking about working with a defense contractor over the concept of initially specialized robots for different military applications. And even like the cost of converting some of the old technology, think of it like a Hummer or Humvee, right? Converting these large swaths of analog equipment that the military has to something more autonomous. And they were going over how much it would cost to put the gyros and all these things in there. And then they had an epiphany. It's like, hold on a minute. We don't need to convert any Humvee or any self-propelled artillery or whatever it may be, a helicopter, to autonomous. All we need is a humanoid robot that can drive it.
Yeah.
And then my mind just exploded because it's like, that's true. If you have the humanoid robot, you don't need a robot mower, a robot vacuum, a robot dishwasher, a robot clothing folder or whatever. The humanoid robot will do it.
Right.
As long as it has opposable thumbs, right?
Yeah. I mean, I think that may be the case for some utilization of that. I still think that maybe there will be classifications of device that exist on their own as robots. I still think there's a strong case for like having a tiny little vacuum, and you don't necessarily need, a humanoid robot using the real vacuum, rolling a Dyson around your house. Cutting your grass for that matter. I guess they could hop on the John Deere and drive it around the yard. That'd be funny.
Very interesting.
That'd be funny.
Next thing you know, that just plows right into your air conditioner units on the outside unit. Just bam, Freon goes everywhere. I don't know. It's interesting. So all that being said is we're on the cusp of some really transformational times that will be gravitational and unescapable. And just seeing what we're seeing with some of these semiconductor stocks is really just the first inning of what's to come. And people are trying to figure out, how do you price all this in? And you just have to stay disciplined.
And that's actually Yeah, I mean, not to interrupt you, but that's actually an interesting conversation to have because, like we're talking about, most of these companies are already exposed to that sector. So, in the event that earnings and revenue from this AI sector, semiconductor, starts to lag, does another one of these kind of ideas come in and replace that? Does the
very
revenue from this new line of
Yeah.
humanoid robots come in and replace the revenue that was there from AI or semiconductor or whatever it is? So there's always things that will come in. It's not a zero-sum game. It's not like, these AI earnings or returns or whatever, all they have. They're companies that are successful, mostly American companies, and they have product roadmaps. They have to. They have guidance for the future. So that's interesting. Didn't mean to interrupt you, but I just thought about that.
No, it definitely is. And I think it just all comes down to the simple fact that as these productivity gains materialize into the real world, then naturally what you're going to see is the rest of the market appreciate as a result of that, even if your semiconductors are down. And that's what we have been seeing a little bit. And it wouldn't surprise me to see it as we walk through the second half of the year.
Yeah. Well, let's move into, we'll just touch really quick. One of the other headlines of this second quarter story was the Federal Reserve. Jerome Powell's term ended. Kevin Warsh took over. He had a first press conference that was sort of shedding light on this change in direction of the Federal Reserve, certainly at the leadership level, certainly at the communication level. We talked about it a couple of podcast episodes, maybe 2 episodes ago. But, you're going into this third quarter with the market pricing in a couple of rate hikes. Whether that happens or not is anybody's guess. As we get more data and fresher data in, they have to take that into account. The fight here is going to be internally between the board governors and Kevin Warsh as the Federal Reserve to figure out which way they go. Them getting rid of the dot plot and all that kind of stuff is going to be, we're not going to have as much insight as we have had in the past in those particular instances. So it'll be something interesting to watch. Not going to spend a lot of time on it, but just looking at that is going to be interesting. Let's see. All right. So what are we looking at for, and we're coming up on time, so we will do this quickly, but what are we going to look for in Q3?
Well, markets entering Q3 at near all-time highs. Credit spreads with the debt, looking at the debt part of the market, are back to having speech issues, back near cycle lows, and the VIX is below 20. So the surface picture is definitely calm. We really have a few questions to kind of shape the next few months. The current setup has the real potential for volatility, obviously, in either direction. But let's look at the most obvious things to pay attention to.
Yeah, obviously inflation, interest rates, main driver of the inflation that we've been seeing has faded or is fading. The question of whether that cooling shows up on the next inflation reports and what the Federal Reserve's response to that on improving data is going to be, that's a big question. That's something we're going to watch. Another oil disruption, if that happens, stronger than expected consumer spending, something we're not anticipating, those could be more favorable for like your hike environments. So we'll see kind of what they say about that.
Yeah, and you have the Middle East conflict's not technically fully resolved. That always can be a variable in the third quarter. And then the question on the AI build out, those historic gains. What do we see? How we see that transition? Does it continue at this pace? Does it decelerate? And if it does, what are the implications for those particular sectors? So expectations are extraordinarily high. So we'll pay very close attention to that. Because definitely over time, the spending, as we have said, needs to translate into both real profits and real productivity gains for the real economy.
Yeah, the last one I would say is the continuation of the markets broadening. So we talked about that. Broad participation is what you want to see in a strong, healthy bull market. So we'll see if that continues in the future quarters. We'll kind of keep an eye on that. Improving margins, resilient economies, all that we'll look at. So we looked at a lot this episode. Not going to keep you guys any longer. But Federal Reserve, inflation, oil, all of the above, great quarter. Hopefully a good sign of things to come in the third and fourth. We still got 2 more quarters in the year. So we'll keep our eyes open for the next quarter.
Definitely not a time to be complacent by any means, but it is showing a diversified portfolio with a long-term perspective is once again proving a reliable and in a relative sense, stable way to navigate uncertainty, to stay allocated for your long-term goals, and even be able to introduce alternative asset classes when the appropriate time is right so that you can participate in this really new economy in this new era that we're seeing all these technologies really shake things up, so to speak.
Yep.
So very, very interesting. That's our Q2 review.
Yeah, that's been good returns. I will say one quick note. We have seen a lot of invites for the Trump accounts officially going out this week. If that's not something that you've taken advantage of yet, a lot of people are thinking that that's only for kids born in the past 2 years. It's not. Any kid under 18 can get some, can take advantage of that fund. If you're a parent, a grandparent, whatever, $5,000 a year toward each child
and I think
into that account.
Dell, Micron, and a few other companies are going to contribute something.
Yep. You get some dollars. You get the most, obviously, if you're born in the last 2 years, but you do get some if you're older than that. So check into that. It's the IRS Form 4547. You have to fill that out, and then you can download the Trump Accounts app on the iPhone or the Google Play. We'll talk more in depth about that next week in the show. We'll maybe do a planning room topic around that. But
yeah, we need to. I need to learn more about that too.
Yeah, so, it's a great idea. But that's been good returns. Thanks for spending time with us today. Hope we've given you some things to think about. If you have any questions, as always, reach out, like, subscribe, comment. Let us know how you're feeling, and hope everybody has a great weekend.
Yeah, happy
4th of July. Happy 4th of July.
Happy 250.
250. Yeah, that's right. We'll see you guys later.
Take care.
Bye-bye.